When global economic powers decide to, well, deploy their financial firepower, what's the ultimate price tag for the nations on the receiving end? We're talking about more than just interest rates here. It's about sovereignty, political choices.
Exactly. And today we're looking at that sort of dual face of U.S. dollar influence. On one hand, Argentina, you see this massive financial intervention stabilizing an emerging market. But, well, it's clearly coming at the cost of long-term economic independence.
And then, the flip side, a major established ally, South Korea, just completely pushing back against what they're calling an impossible financial demand, almost a shakedown.
Right. So our goal here is to really unpack these maneuvers, look at the mechanisms of dollar power, and try to figure out if stability is being offered, as a lifeline, or maybe more like a very effective leash.
Yeah, essentially how geopolitical loyalty is being priced, right?
Yeah.
Paid for in hard currency.
That's it.
Okay, let's start where the political shockwave hit most recently. Buenos Aires. That Argentine election. Javier Milei secured a surprisingly huge mandate, didn't they? Almost 41% of the vote. It just wiped out the opposition.
Yeah, that kind of win gives him significant political capital. And the initial market reaction, it was pure euphoria. Argentine stocks, well, they basically flew to the moon, jumped 50%. You had big banks saying, okay, Argentina's finally turned a corner.
But the reality on the ground, it sounds far less rosy. The economy is still structurally pretty shaky, isn't it?
Oh, definitely. I mean, inflation's down to 25%, which, look, for them is a major improvement, but globally, that's still incredibly high.
And what's striking is how much they seem to rely on external factors. They're deep in an economic contraction, growth-wise.
Right. And the whole plan seems to rest on driving massive export growth, mostly private sector, farming, because the public sector is facing severe cuts, job losses are happening. Domestic consumption just isn't enough to drive any kind of real recovery. They have to sell abroad.
Okay, so that brings us to the really crucial question. Given this underlying fragility, and knowing that just weeks before the election, the peso was crashing, bonds were collapsing, how did Milei manage to find the stability needed to actually win? What was the game changer, financially speaking?
Well, that was Scott Besson and the U.S. intervention. This wasn't subtle at all. It was a coordinated, pretty blatant currency rescue effort, timed, it seems, specifically to prop up the market just before the vote.
Scott Besson, he's that key figure, right?
Mm-hmm.
The hedge fund manager, often seen as the U.S. administration's sort of go-to economic operator in Latin America. So what did this intervention actually involve? Can you give us the specifics on this financial lifeline?
Sure. It essentially came in two big waves totaling billions. First, they arranged a $20 billion currency swap deal directly from the U.S. Treasury. Now, you need to understand this isn't free money, a currency swap. It's basically an agreement where central banks exchange principal and interest in different currencies.
So Argentina gets a huge immediate injection of U.S. dollars.
Exactly, much needed liquidity. But they have to pay interest on that swap. And look, those interest costs are almost certainly much higher than standard U.S. bond rates.
So it's debt, effectively, but structured specifically to stabilize the currency market right now using U.S. taxpayer backing.
Precisely. And the second part, that was Besson's direct action in the market. He sold a huge amount of dollars to buy up about $1 billion worth of Argentine pesos. That directly propped up the local currency.
Wow.
And on top of that, there is another pledge, an additional $20 billion from Wall Street banks, specifically earmarked to finance Argentine private industries.
That is enormous leverage. Why is the U.S. committing such significant resources? What's the bigger geopolitical play here?
Well, Besson himself has been pretty open about it. The main driver is establishing what he calls Fortress America, and that explicitly includes South America. It's meant as a financial and industrial shield against China.
China's growing influence.
Exactly. China is flooding Latin America with industrial exports. Cell phones, EVs, machinery. The U.S. sees the dollar system as its most potent tool to support allies who are politically aligned and, frankly, to push back against that Chinese influence. It's a very expensive way of buying loyalty, essentially.
The short-term benefits seem clear, though. The immediate crisis was stopped, the peso got a boost, those dollar bonds bounced back quite a bit. U.S. backing brings credibility, makes investors willing to lend dollars again. But you called it an insidious trap earlier. Why?
Because Argentina is now, well, completely dependent on Besson and the U.S. Treasury for dollar liquidity. Think about it. They turned down the invitation to join BRICS. They didn't ask China for an alternative currency swap.
They chose their side.
They did.
Okay.
And their long-term plan is total dollarization, basically getting rid of the peso altogether. But to even get close to that, they have to close that painful 10–20% gap between the official peso rate and the black market rate.
Which implies another big devaluation is coming.
It seems almost unavoidable, and that's politically agonizing. It hits ordinary people hard.
You mentioned a vice grip. Couldn't Argentina argue, though, given the absolute chaos before, that this stability, even with the dependency, is worth it? More like a life raft than a vice grip.
I mean, that's certainly the calculation they appear to be making, but the cost of that lifeline is escalating debt. We're looking at a potentially horrifying long-term debt spiral. Argentina needs something like $10 billion a year minimum for the next 3 years just to pay its existing bondholders.
And where's that money likely to come from?
Almost certainly from drawing down that U.S. dollar swap line we talked about. And each time they draw on it, the debt gets deeper, the U.S. influence gets stronger. It just cements their reliance year after year on the U.S. financial system.
So the real, perhaps unwritten cost isn't just the interest payments, it's geopolitical flexibility. Does this impact their relationships with other countries, say China? Does the U.S. backing mean they get, first dibs on developing resources like Argentina's lithium?
Those are the almost inevitable consequences, aren't they? When you're financially dependent, your trade decisions, your investment choices, they become highly politicized. You could argue the U.S. has scored a massive geopolitical win here by effectively locking Argentina into its economic orbit.
Okay, so if Argentina shows the potential cost of accepting that U.S. dollar influence, let's pivot now to South Korea. Because that seems to show the cost of being a major ally that's trying to resist it. This is a crucial U.S. partner, but they seem really tired of the economic demands.
Yeah, and this really raises fundamental questions about what alliances mean today. South Korea is a global powerhouse in chips, electronics. They badly want the U.S. to reduce tariffs on their goods, currently 25%. They want it down to 15% to stay competitive.
Especially with their economy slowing down.
Exactly. Their GDP growth forecasts are already sluggish, less than 2% for the next couple of years. They need every single trade advantage they can get.
And what was the price the U.S. reportedly demanded for that tariff cut?
An upfront payment of $350 billion in cash.
$350 billion.
Billion. With a B. And you have to put that number in context. South Korea's total foreign reserves, basically the nation's emergency savings, mostly dollars and gold, stand at only around $420 billion.
So they're asking for over 80% of their entire national savings account.
Precisely. It's an impossible ask. It's just not feasible.
It really is. I mean, think about it personally. If your household suddenly had to pay a bill that took 80% of your entire life savings, you'd be left completely exposed, wouldn't you?
That's exactly the point. Reserves exist for crises, right? Like if the dollar suddenly surges or the country needs hard currency to pay off huge dollar-denominated debts, which most international debt is, wiping out those reserves makes the whole economy incredibly vulnerable to a catastrophic liquidity squeeze.
So how are the Koreans pushing back? They obviously can't just write a check for $350 billion.
No. They're pushing for a mixed deal. Maybe some loan guarantees, perhaps equity stakes in some key national companies, maybe loans, but definitely not all cash up front. They understand the risk. Korean officials seem particularly worried that just paying this could trigger a self-fulfilling currency crisis.
Explain that dynamic for us. How would paying the fee itself potentially crash their currency, the won?
Well, think about how they'd raise $350 billion in usable U.S. dollars. They'd have to sell a massive amount of their existing dollar reserves. When they sell those dollars and convert them back into their own currency, the won, it floods the market with won.
Basic supply and demand.
Exactly. Selling that much of their reserve asset would absolutely clobber the Korean won. And the won has already dropped over 3% against the dollar recently, just on market nervousness about this whole situation. They'd essentially be causing the very crisis they're trying to avoid.
Plus, any money they give up is money they can't spend at home, right? South Korea, like Japan, Germany, China, they're all subsidizing local industries to stay competitive globally.
Absolutely. Giving up $350 billion means losing critical domestic investment needed for future growth, for jobs, for innovation.
The disagreement sounds
Yeah.
epic, as you said. Is the market reacting to this standoff?
It is, and it's confirming the Korean officials' worst fears. We're actually seeing significant capital flight happening right now. South Koreans themselves are dumping the won, moving their money into U.S. stocks, into gold.
Even into U.S. bonds?
Yes, even buying U.S. bonds, which is ironic, isn't it? They're essentially helping to finance the U.S. Treasury while their own government is facing these huge financial demands from the U.S. It shows they're seeking safety where the U.S. dollar is still seen as supreme.
The U.S. is clearly playing hardball here, trying to maximize its financial position.
Yeah.
But demanding this much? It risks fracturing a really strategic alliance that's been built over decades, doesn't it? And if Korea is facing this, you have to assume other key allies, maybe Japan, could be facing similar demands down the road.
It really highlights how central the dollar system is to geopolitical maneuvering today. Nations feel forced to acquire dollars, often through deals that aren't really in their best interests, simply because that's the currency most global debt is issued in. You need dollars to function in the global economy.
So we've looked at two pretty extreme examples of dealing with dollar power. Argentina, accepting U.S. help, achieving stability, but at the cost of long-term dependency. A geopolitical win for the U.S., perhaps.
Right. And then South Korea, resisting the pressure, risking a major currency crisis, triggering capital flight, potentially straining a vital alliance.
Both situations really demonstrate the overwhelming leverage the U.S. holds through the dollar system. It seems geopolitical loyalty isn't just about shared values or defense treaties anymore.
No, it's explicitly tied to financial compliance, it seems.
So wrapping this up, what does this signal for the global economic landscape? In this kind of environment, where alliances are strained by these huge financial demands, and loyalty is literally being paid for in dollars, how long can the U.S. keep this level of control before allies, even really close ones like South Korea, decide the cost of dependency or the cost of these demands just outweighs the benefits of the alliance itself?
That really is the crucial question these events force us all to think about, isn't it? How sustainable is this model in the long run?